Hi, and welcome to our shortcast. I'm your host, Howard Drukarsh. I've been a successful agent in Canada's largest market, Toronto, for over 30 years. And in the latter part of my career, I co-founded Canada's largest independent brokerage, Right at Home Realty, with a roster of over 5,800 agents and growing. In 2020, I retired to start this podcast, and it's been a remarkable opportunity to meet highly successful and fascinating guests in real estate and related fields to find out about their careers and get their insight into our business. Today's guest is a repeat guest for us on our shortcast. It's Ted Tsiakopoulos. And because his title is so important, I'm not going to mess it up. Ted is the Senior Economist Specialist, Housing Markets Policy at the Canada Mortgage and Housing Corporation, most people know as CMHC. We had Ted on before, and today's visit again with Ted is because there's so much discussion around interest rates, impact of interest rates, whether it's from journalists, people in real estate, mortgage people. But I and the other people here at Realcast felt it was good to have an economist on, and Ted was kind enough to join us. So Ted, welcome back.
Thank you, Howard. It's great to be back.
So, in the effort of keeping our shortcast to a shortcast, I did write some questions down. Is it okay if I start with that?
Sure.
Okay.
Sure. Yeah.
So when we spoke last time about the why actual inflation and inflation expectations are so important to not only the cost of living, but the direction of interest rates, we know that rates are moving higher, and we know why. Well, what do higher interest rates mean for those with existing mortgages and new buyers looking to jump into the market?
Yeah. And this is the real $1 million question. We know that those with existing mortgages, have bought some insurance. Just over 50% of, new mortgages issued in recent years were fixed rate mortgages, and about two-thirds of those were carrying a 5-year term. So clearly, these folks know what their mortgage payments will look like, even in the midst of rising interest rates. So there isn't much stress here until possibly renewal time for those existing mortgage holders who are holding fixed rate mortgages. Alternatively, I would say that the real risk is for those, carrying um, a variable rate mortgage. And as you know, variable rate mortgages are tied to the prime rate. And we know the prime rate moves up when the Bank of Canada starts to increase interest rates, which is the environment we're in right now. Uh, and so, households holding variable rate mortgages, is there a big risk of default here? Um, and I would say probably not a big risk, likely because a lot of these mortgages, whether we're talking about fixed rate mortgages or variable rate mortgages, a lot of these mortgages, Howard, have been stress tested. And so what does that mean? It means that you weren't only qualified on the mortgage rate on your contract, what you were approved for, but banks went a step further and said, okay, well, we could be moving into an increased interest rate environment. So we want to ensure that when rates go up 1 point or 2 percentage points, you're still able to make those payments. And so the good news here is that mortgage holders generally have been stress tested. So where is the risk? Where as long as the economy continues to grow, as long as we continue to generate jobs, and that is what the consensus forecast is. Albeit slower growth, as long as we're still growing, as long as jobs are being created, and the unemployment rate, which is critical, remains low, I think default should remain low. And we know, based on history, Howard, that households will do whatever it takes to pay their mortgage. They want to ensure they have a roof over their head. So more often than not, they're more likely to become delinquent on credit card and personal loans before defaulting on their mortgage. So that's certainly good news. The real concern here is for first-time buyers, people looking to get into this market. And it's becoming increasingly difficult for first-time buyers, even with the bank of mom and dad support. Okay. And so we've done some modeling in the past, Howard, and what we found was that for every 1 percentage point increase in mortgage rates, existing home sales, which is a proxy for demand, drops by about 5% across the country. 5% seems to make sense even in the Ontario region. But I would say in recent years, because households have become more indebted and more vulnerable, I think that number is probably closer to 8%. So for every 1% hike in rates, you're going to see an 8% drop in existing home sales. So you multiply that by two, we're looking at about a 16% drop in mortgage rates. So, you know, the first-time buyers are going to feel this effect. I would say that if you're thinking about buying a home, clearly medium to longer term, there is some good news here. We do expect housing markets to be better supplied, more choice in the market, and prices probably growing at a much slower rate than what we've seen over the pandemic. And so, just to sum up here, I truly believe that rising interest rates don't carry zero risk or low risk. I think we really need to monitor what rising interest rates mean for the broader economy, because we know that purchasing power starts to decline not only when rates go up, but also when inflation is growing at 5, 6, 7%. Um, and we know that for every dollar that households earn, I would say about um, 60 to 70 cents goes to pay down that mortgage. So as rates go up, that number continues to grow. And that means there's less money left over to buy other goods and services, to take a vacation, to go out for dinner. So eventually the broader economy is going to feel this effect. And so that's what economists call sort of a negative income effect. The weight of not just rising inflation and the cost of living, but also now a double whammy with interest rates moving up. It suggests that there's less money left over for consumption of other goods and services.
What a great explanation. When I was selling, one of the things that we sort of understood was when first-time buyers are unable to enter the market, it affects everything because the homeowner ready to move up doesn't have a market there for him. So I don't know how that plays into the statistics, but I don't think it has changed because first-time buyers have to be there to move everything. And the other thing, if I was a first-time buyer and listening to you, it becomes the same roll the dice, doesn't it? Fixed mortgage, variable mortgage, and there's no one can see the future, right? So what do you think people will be doing when they see this kind of slow to medium growth in interest rate incline? Do you think people will go variable because they're afraid to lock in?
Actually, the reverse. What history has shown, Howard, is that when the gap between fixed and variable rate mortgages begins to narrow, i.e., variable rate mortgages catch up to fixed rate mortgages, people actually begin to consider locking in, right? They don't want to stay in a variable rate product because they're exposed, because that rate floats with, the general increase in the Bank of Canada interest rate. So what we found historically is, you start to see people choosing to lock in. And so just to throw some numbers at you, over the last year or two, of all the mortgages that were issued, we saw that variable rate mortgage attractiveness, in terms of market share, it went from about a third, Howard, 33% of all new mortgage originations were variable rate mortgages, to almost 50%. So I suspect we're going to see that number come off over the next 6 to 12 months as people try to buy more insurance, try to kind of protect themselves in a rising interest rate environment.
Yeah, that makes sense. I think the thing is that nobody can see the future, right? I mean, you do have the benefit of historical data, and you are an economist, so it's better than asking your uncle what he thinks. But this, what drives real estate? Consumer confidence has always been a big factor. Interest rates, everybody knows that drives real estate. So, having you come on to kind of help people understand a bit about well, more than a bit, to understand how is this going to affect them as a homeowner or as a first-time buyer. It's great. Well, let me move on to my second question, because this one's really interesting for me. The stock market and the real estate market are moving in similar direction. What's the common theme for that?
Yeah, really interesting question. There is no doubt in anyone's mind, or there shouldn't be any doubt today, that given all of the fiscal and monetary policy stimulus that we've seen to dig us out of the COVID-19 challenges, that we've built up some froth, not just in the housing market, but also in the stock market. So, and some of that froth, we have to give some of that back. And that's what we're seeing in the stock market. In fact, the stock market right now is in a bear market. Okay, we've seen declines of 20% or more across some exchanges. For housing, the jury is still out on whether we're in or we're going into a bear market, or what we call sometimes a housing price bust a cycle. It really currently, Howard, looks more like it's a more milder correction than what we're seeing in the stock market.
Mhm.
But we cannot rule out something more severe, especially if central banks are unable to orchestrate what we call, the infamous soft landing, a soft landing in inflation,
Mhm.
and a soft landing in growth. If we get a hard landing in growth, i.e., a recession, then all bets are off that we're going to see a mild correction in house prices. We could very well be setting us up for something more severe. Um, but what both a drop in stock prices and real estate prices do, Howard, is they create a negative wealth effect. So we talked about a negative income effect in the previous question. Now we get this negative wealth effect. So what is this? What does this mean? It's a bit different because what it is if you're a household and you own stocks or mutual funds in your portfolio, but you also own real estate, either as an end user or as an investor, then when those asset prices start to drop, you as a household feel less wealthy. And so if you feel less wealthy, you're going to be less inclined to go out on a vacation, buy a new car, go out for dinner. That's where the negative wealth effect comes in. And research has shown that for every $1 drop in house prices here in Ontario and in Canada more generally, you get about a 5-cent hit to consumption.
Hmm.
Okay, so for every dollar decline in average house prices, consumption drops by about 5 cents. Now, if you multiply that dollar by a million, okay, or not a million, let's say hundreds of thousands dollars. Let's say prices drop by 100,000 or 50,000. It starts to add up in terms of consumption. Consumption is really going to feel the effect of this sort of negative wealth effect that I've introduced here. So hopefully that kind of gives you a clear picture of what is the common theme between the stock market and housing, and potentially what could happen.
No, it's a great explanation. I think most people, if you're just reading headlines, what you've read is interest rates are going up, but no explanation of how could that affect me, as a consumer, as a homeowner, as a business person. So, okay, this was one more question. If we had time, and we do, I wanted to ask you. There are not many forecasters calling for a persistent and sharp drop in home prices, but what could trigger such an outcome?
Yeah. So another $1 million question. Yeah, for sure. Well, if you look at all the forecasts out there right now, on average, most forecasters, including ourselves, are assuming a soft landing in home prices. So we're assuming that there will be a floor, and that we won't see a 20, 30, 40% drop in house prices. It'll be a milder drop. you know, um, Now, the average annual price may not drop because we've entered 2022 so strongly, but from peak to trough, we could see, I think the average is people are calling for about a 10 to 15% drop. Now, again, that's not average annual drop, it's just a peak to a trough.
Mhm.
Um, but there is a risk that we could see a more severe correction. And historically, if we go back in time, back as far as the 1960s, 60% of the time when we've seen a more severe drop in house prices, what were the triggers? Well, a recession was clearly a big trigger. Okay. Second was something you alluded to earlier, Howard, a drop in consumer confidence, another trigger. Okay. And high levels of overvaluation in the housing market. And boy, people hear overvaluation and it sounds like a technical term, but what this means is housing prices being well above the fair market value of where they should be, of where fundamentals suggest prices should be. So those are been the three big triggers. Okay. And a fourth one was that we also saw some policy changes over time. So whether it was, policy change that reduced investor activity, back in the 1970s, you may recall Toronto City Mayor, his name escapes me, and it shouldn't. He came out, and the federal government sort of came out and increased the capital gains inclusion rate on investing. Okay, from 50 to 75%. Well, that had a real effect, right? So those are really the four big triggers that I'm keeping my eye on. And the last time we saw the perfect storm, Howard, a lot of people sort of point to the early 90s, late 80s, early 90s in Toronto, where we saw most of these triggers kind of in play. But mid to late 1970s, we also saw all of these triggers present. And that was a time when we were talking about stagflation, high inflation, slow growth. Sound familiar? Yeah. So we can't sort of discount this as a potential scenario. It's not the baseline, but it is a potential risk. And so this is why central banks are trying to navigate the economy closer to a low inflation and low growth kind of environment. It's critical that they get there, but as I say, this is a very delicate balance and a potential risk. So, yeah.
Well, Ted, it's always a pleasure having you come on and explain things from a sophisticated and not a guess, which I think, is it a guess? It's a guess based on historical data versus asking your uncle. That's kind of the way I look at this. So we're gonna have you back again, as we do periodically, to give us some more insights into housing and the economy. And I want to thank you for coming in today to share your expertise with us. And we'll see you again soon.
Great. Thank you. And great to be here. And we'll talk to you soon, Howard.
Okay. Thank you, Ted. All the best.
Take care.
Bye-bye.
Bye.
We'd like to thank Ted Tsiakopoulos and you for joining us today. And if you enjoyed our shortcast, please like, comment, and subscribe on your favorite podcast network or on our YouTube channel. And if you'd like to reach us, you can reach us either by email at info@rewithhd.com or on our website, rewithhd.com. Thank you for joining us, and we'll see you next time.